Welcome to Trading Nation. I'm Eric Chemi. Today we're joined by Tom Lee. He's head of research at Fundstrat Global Advisors. Tom, thanks for joining us here. I got to get right into it. You're known as one of Wall Street's biggest bulls. You've got this 3,025 price target for the end of the year. How low do we have to go before you change your mind on that?
Well, you know, it's been a rough couple of days, actually a couple of weeks. And I think it's just a reminder that, volatility, which essentially disappeared in 2017, is something that we're starting to see come back. I don't think it really changes where the market can end up by the end of the year, because we're just modeling essentially a static PE plus some earnings growth to get to 3,000 versus the start of the year. So I think 3,025 is still attainable.
What happened? I feel like everything's just opposite. A year ago, going into 2017, everybody said this is going to be the year of volatility because of, let's just say, Trump. That's going to create volatility. The exact opposite happened. Then all of a sudden, at the end of 2017, everybody said, well, we had a very good year without volatility. That trend's going to continue. And then that's been completely dead wrong. So why is the consensus just totally wrong the last couple of years?
Well, I think one of the things that happened last year was, with the economy running and expanding, core inflation actually fell. And that took a lot of pressure off the Fed. So if you can imagine, if you reduce inflation and volatility follows that lower, it really supported an expansion of multiples. And I think one of the differences this year is that we still have an economy that's expanding and nearing full capacity. And now we're throwing some stimulus. But on top of that, it looks like signs of leading indicators of inflation are really picking up, which is through the wage channel. And so I think now with inflation, that's bringing back volatility, and it is forcing investors to rethink the relationship between stocks, bonds, and also volatility and PE.
When I look at this chart here, the S&P, it reminds me of a chart of Bitcoin over the last few months. And I know there's some chatter out there saying, oh, it was the Bitcoin crash first that led into the stock market crash. I don't know if I buy that, but can you help walk us through what might be going on there, if that's even a real situation?
Yeah. Well, in some ways, in the past 12 months, not only did we have a strong rally in equities, we had a strong rally in cryptocurrencies. And that did bring in quite a number of investors, right? Individuals opening Coinbase accounts, and then institutions entering the market through futures, and some actually buying coins outright. So I wouldn't be surprised if those investors who saw risk on assets everywhere outperforming globally were also buying cryptocurrencies. And so I think as Bitcoin began to weaken and they de-risked, it could easily look like a chart that looks like the S&P, because both had a parabolic move in and then subsequently gave back some of those gains. But I think the connection between the two is really, really limited.
So limited just psychologically, or there's different traders? What does that mean, limited?
Well, across the board, I mean, cryptocurrencies have their own economy. It's based on activity on that blockchain. Equities have their own economy based on earnings per share multiples. The institutional overlap is essentially zero. Our clients who own equities, not even single digits, like mid-single digits, even own any crypto. So there's very little institutional overlap. And when you look at the ownership of Bitcoin, it's 80%, maybe 70% outside the U.S. It's really a globally held asset class. So I would say I think they're very limited. Plus, consider size, right? Bitcoin's $100 billion market cap. The S&P 500 is close to $30 trillion.
Right,
I mean,
it's less than one company on the market, basically. It's not that much size. But I want to get to, Tom, just real quickly here, 8660 Bitcoin we're seeing on the chart. What's a target there? You've got 3025 for the end of the year S&P. Are we going to see 3,000? Are we going to say 30,000 Bitcoin by the end of the year? Where does this go, Tom?
Well, we believe Bitcoin will see 20,000 by mid-year. So in the next 5 months, a real recovery in price. And then 25,000 by the end of this year. So, we see Bitcoin essentially tripling. So, we're still very constructive on cryptocurrencies. Bitcoin is still the most important and liquid of those crypto assets.
All right, Tom Lee, that does it here for us on Trading Nation. Thank you for joining us, Tom. To everybody else, we'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.